We are diving deep today into one of the most persistent myths in finance.
The idea that great wealth has to be complex.
Exactly. We are ripping that idea apart. We're looking at a strategy that relies on only 3 funds.
So simple, anyone can use it, but, and this is the key, powerful enough to build generational wealth.
But we have to be real here. We are also going to reveal the almost $1 million mistake that most people make.
Just by waiting 10 years to start, it's shocking.
You're with ChannelVest, your expert in ETF strategies. Okay, let's get right into our mission today. I'll just read the title out. Warren Buffett's $154 billion secret, the only 3 ETFs you need in 2026.
It sounds, I know, a little aggressive, but the premise is genuinely shocking. We are basically synthesizing the wisdom of the Oracle of Omaha.
The $154 billion man.
Into a shockingly simple systematic formula. And our goal for you today isn't just naming 3 tickers.
Right.
It's about constructing a portfolio that perfectly balances, explosive growth, reliable income, and that crucial stability.
And we are going straight to the hidden math of diversification. We're going to show you where these funds overlap, where the secret risks are hiding.
And how this simple 3-fund structure just mitigates those risks better than anything else.
But first, the ground rules. We have to say this. This is pure, impartial research and educational content only.
Right. We are not giving you personalized financial advice. You've got to consult a registered professional for that.
We just want you to be a fully informed investor.
And look, because this deep dive is about to fundamentally change how you view your investments, just take a second. Right now.
Please, hit that subscribe button. And leave us a comment below. Tell us what you're currently holding in your portfolio. We'd love to see it. All right, let's jump straight into the great contradiction, the thing that defines this entire space.
Okay.
The next title is The $154 Billion Paradox. What Buffett says versus what he does.
This is truly mind-bending. For years, Buffett has given this very clear, simple advice to the average person.
Especially for after he passes, right?
Yeah, exactly. He says put 90% of your money into a low-cost S&P 500 index fund.
And 10% in short-term government bonds. Simple, cheap, effective.
Simple for us?
Simple for us, maybe, but not for him. We looked at Berkshire Hathaway's massive, $258 billion public portfolio?
And you ask, how much is in S&P 500 index funds?
0. Absolutely 0%. It's unbelievable.
Instead, his firm runs this high-conviction, super concentrated stock-picking strategy. Massive bets.
I mean, we're talking over 22% in Apple. Almost 19% in American Express.
And that paradox right there, that teaches us the most critical lesson. You and I, we are not billionaire stock-picking geniuses.
Not at all.
We don't have his decades of experience or proprietary info. Our path to wealth needs a systematic, reliable machine, not these concentrated bets.
So we need to follow his philosophy of simplicity, but apply it in a way that gives us better, more systematic diversification than he even has.
Which brings us right to the components of our investment machine. So the title for our foundational assets is The 3 ETFs That Change Everything.
We have selected the 3 champions. I like that name. And first, you got to have the bedrock, the foundation.
VOO, the Vanguard S&P 500 ETF. It is the gold standard.
I mean, it has a staggering $793 billion in assets under management, or AUM.
That's how much cash the fund holds. It's huge.
Yeah.
And the fee is virtually free, 0.03%.
It's the core. It captures, 95% of the U.S. market cap?
Then we add the firepower, the growth engine, and that's QQQ.
QQQ. It tracks the NASDAQ 100. Right now, it is the best proxy for the whole AI revolution.
Oh, absolutely. I mean, it's got 64% technology exposure. This fund is explosive. We're talking annualized returns of 16.26% since it started.
And finally, the piece everyone misses, the defense. SCHD, the income machine.
This is our counterweight. It offers a high 3.81% yield, and that's sourced from over 100 of these high-quality companies.
The dividend aristocrats.
Exactly. Companies with long histories of increasing their payouts. This income, this is your psychological anchor when the markets, inevitably fall. So let's break down that foundation. The title reads VOO, the cornerstone nobody talks about. VOO is, it's undeniably dominant. It just hoovered up $71 billion in new money.
In the first 9 months of 2025 alone. That's insane.
And its average annual return since inception, it stands at a remarkable 14.54%. It's cheap, it's reliable, it is the cornerstone.
And this is a huge but. Here is the massive problem we found when we dug into the holdings.
What is it?
VOO is suffering from the exact same concentration risk as the total market.
So even though it holds 500 companies,
it doesn't matter. The top 10 holdings make up a staggering 38.73% of the entire fund.
Almost 40%, driven mostly by big tech.
Look at the numbers. NVIDIA alone is nearly 8% of VOO.
Wow. So if big tech corrects, VOO is going to feel it and feel it hard.
Exactly. This is why we need the other 2 funds, to mitigate this crazy reliance on just 7 companies, which makes our next component look particularly attractive right now. The title here is SCHD, the Broken Dividend Machine. So if you just look at the 2025 performance, the numbers are, well, they're shocking.
They don't look good.
Not at all. While VOO gained 12.4% and QQQ surged, SCHD actually delivered negative returns, minus 1.86%. It looks broken.
And we know why this happened, right? The fund manager deliberately shifted. They slashed their tech exposure down to just 8.76%.
And they surged into traditional value sectors like energy, which went up to 19.5%.
But this shift, this is what created the opportunity. It means SCHD is currently trading at a price-to-earnings ratio, a PE ratio of just 13.01.
And the PE ratio tells you how expensive a fund is relative to its earnings. So compare that 13.01 to VOO's PE.
Which is what, 28.36?
Exactly. SCHD is currently trading at a 54% discount to the S&P 500.
A 54% discount. That is a massive value.
It's cheap, it's paying you a high yield of 3.81%, and it's genuinely diversified away from big tech. It's the greatest opportunity hiding in plain sight.
Now, for the asset that creates the dilemma, the title is QQQ. The tech gamble Buffett would never admit to.
This is the rocket fuel. And you can't deny the historical performance.
No, you can't. QQQ's 16.26% annualized return since inception just absolutely crushed VOO's 11.97%.
Let me give you an example. If you had invested $10,000 back in 2011, QQQ would have turned that into $83,443.
And VOO?
VOO would have given you $49,137. The growth is just spectacular.
Okay, so here's the question we have to ask. If QQQ performs that much better, why would we ever recommend holding 50% or more in VOO?
And the answer is risk. It all comes down to risk.
Yeah.
QQQ's volatility is high, 21.45%.
And its deepest drawdown was nearly 40%. It's also extremely concentrated. 80% of its returns are driven by the top 50 holdings. It's an aggressive, targeted bet.
And that aggressive bet leads us right to the biggest portfolio risk that I think investors face today. Let's look at this, the Magnificent Seven problem.
So you might think you're diversified because you own VOO and QQQ.
But you are not. They share a massive 52% overlap by weight.
52%. You are literally double betting on that handful of mega cap tech stocks. You know, the Magnificent Seven.
Let's get specific. NVIDIA is 7.95% of VOO.
Plus it's 9.9% of QQQ.
You are just concentrating your risk into the same handful of companies everyone else is betting on. If you own just VOO and QQQ equally, your total Mag 7 exposure would be a dangerous 36.6%.
But here's the beauty of the three-fund solution. It's mitigation. By using a conservative starting allocation, let's say 60% VOO, 25% QQQ, and 15% SCHD, we slash that Mag 7 exposure.
From 36.6% all the way down to just 21.8%.
That is a massive 40% reduction in concentration risk, simply by adding that true value and income counterbalance with SCHD.
And that counterbalance is so crucial when the market inevitably, enters a period of stress. Let's analyze crash behavior, the 2020 versus 2022 revelation. We need to understand the personality of these funds when they're under pressure.
Right.
During the 2020 COVID crash, that was a fast systemic shock. SCHD actually suffered the largest immediate drop.
But it recovered in a pretty quick 13 months.
But the real revelation? The real eye-opener came in the 2022 growth correction.
When high-flying tech stocks got absolutely hammered by rising interest rates.
Exactly. In that environment, SCHD crashed the least, and it recovered in just 7 months.
Dude, this proves its role. It's the stabilizer. When the growth story fails, value steps in.
And crucially, that 3.81% dividend yield, that is the psychological anchor we were talking about.
So when your portfolio value drops, you're still getting that consistent cash flow, that tangible payment.
And that's what prevents you from panicking and selling at the worst possible time. QQQ recovers explosively. SCHD provides the defensive stability you need to stay the course.
Okay, let's talk about the detail that often, it paralyzes new investors, the expense ratio paradox.
The numbers here, they can be intimidating. The fee difference between VOO at 0.03% and QQQ at 0.20%.
It's 0.17%. And over 40 years, that little difference compounds to a staggering $139,281 lost to fees.
So the conventional wisdom says always, always chase the lowest fee.
And here's the historical twist. Despite VOO being dramatically cheaper, QQQ's superior historical performance.
That 16.26% annualized return.
It has completely offset that fee disadvantage and then some. It's totally counterintuitive.
So what's the real takeaway here? I mean, fees matter. Of course they do.
Absolutely.
But chasing a few basis points is a huge mistake if it means you sacrifice your allocation discipline. Sticking to the right plan, the right allocation, that matters so much more than minimizing fees at all costs.
And that allocation is what we are about to reveal in our age-based blueprint. So if you are serious about implementing this strategy,
you need to subscribe to Channel Vest right now.
Hit that notification bell and tell us your age bracket in the comments.
All right, let's get you that blueprint. The title is Your Age-Based Allocation Blueprint, ages 20-35, Aggressive Growth. Okay, if you are in the first stage of wealth building, you have the advantage of time. So you need to lean into growth, lean into volatility.
We recommend an aggressive allocation of 50% VOO, 40% QQQ 10% SCHD.
This is how you just maximize the power of compounding.
This aggressive mix has an expected return of 12.1%. And by sticking to this plan for 30 years, our models show the portfolio value reaching a massive $2,978,003.
This is the pathway. This is how you build generational wealth. Now, obviously, we have to adjust for risk as time runs down. The next title, your age-based allocation blueprint, ages 35-60.
For ages 35 to 50, we shift into what we call balanced accumulation. We pull back 10% from QQQ's volatility, and we double the SCHD position.
So the new split is 50-30-20.
Exactly. The expected return is still really robust, 11.4%, and that generates a 30-year value of over $2.5 million. We're introducing more defensive income here without giving up too much growth.
Then as we approach the home stretch ages 50 to 60, the pre-retirement phase stability becomes the key.
It's paramount. So we move to a 40-20-40 split. SCHD now takes a major role,
which boosts stability and reduces that overall volatility significantly. The expected return drops a little bit to 9.8%, but that's a necessary trade-off for mitigating risk.
And finally, when the goal shifts entirely to cash flow, the next title is Your Age-Based Allocation Blueprint, ages 60 plus. For the income generation phase, so ages 60 to 70, the weighting flips dramatically. We're focused on maximizing that defensive dividend flow.
So it becomes 30% of VOO, 10% QQQ, 60% CHD.
That heavy SCHD exposure leads to an estimated monthly dividend of $1,648.
And that consistent cash flow is the entire point of this stage.
Then for the final stage, preservation, so ages 70 and up, you're focused on legacy. We drop QQQ to a minimal 5% and push SCHD to 65% of the portfolio.
And this gives you the lowest volatility we model, just 5.4%, prioritizing capital preservation above everything else.
Now for what I think is the most sobering truth of this entire deep dive.
It's a tough one to swallow.
The title is The $973,838 Cost of Waiting.
We showed you the massive potential wealth if you start early. Start at age 25 with that aggressive allocation. You're getting nearly $3 million.
If you hesitate, if you procrastinate, and you wait until age 35 to start with that slightly less aggressive midlife allocation,
your 30-year result drops to just over $2 million. $2,004,165.
The cost of that 10-year delay, a stunning $973,838.
Almost $1 million. Gone. Not because of a bad investment, but because of inertia.
This data is the proof. Market timing is the enemy of wealth building. Time in the market is your greatest and most expensive ally. Okay, let's review the tension that really defines this whole strategy. The title reads, Bull versus Bear, the ultimate showdown.
The bull case for our three-fund portfolio is, well, it's irresistible. SCHD's current 54 PE discount makes it the value opportunity of the decade.
Meanwhile, QQQ is capturing the explosive potential of the AI revolution, and VOO provides that broad market baseline.
We've diversified across risk factors, growth, value, and income, not just across company names. But the bear case, it has weight. We have to acknowledge it. VOO's top 10 concentration creates index bubble risk.
And QQQ's 0.2% fee is significant compared to VOO. And that 52% overlap between the two growth engines means you are always carrying significant risk concentration.
The truth is, both sides are right. Both perspectives are correct.
And that realization is why your allocation discipline, your commitment to annual rebalancing, those are the absolute keys to success. It's not about finding the perfect three funds. It's about managing the known risks within that combination.
So let's make this actionable for you immediately. The final title is Your Action Plan, What to Do This Week. We have 5 concrete steps for you to start building that nearly $3 million future. 1, determine your age-based allocation blueprint. Right now. 2,
open a brokerage account with a low-cost provider. 3, set up automatic monthly contributions. This is called dollar-cost averaging, or DCA. It removes all the emotion from your decisions.
4, buy your initial allocation. Now, we suggest buying your VOO anchor first and then scaling into SCHD and QQQ over the next 3 months to mitigate that timing risk.
And 5, set an annual rebalancing reminder. If any position drifts 5% or more from your target, you adjust it back.
And here is the critical advice based on today's market conditions. Buy SCHD immediately.
Given its near 52-week lows and that phenomenal 3.81% yield, this is the best entry point we have seen in 3 years. We have walked through Buffett's secret, we've exposed the hidden math, and we have given you the exact blueprint. But the journey continues.
It doesn't stop at the initial purchase. The next title is Don't Miss What's Coming Next.
Next time, we are revealing advanced tax optimization strategies.
These are techniques that can save you $50,000 or more over 30 years in capital gains alone.
We'll also cover professional rebalancing strategies and, maybe most importantly, the behavioral psychology that separates successful long-term investors from average traders.
Remember that $2.9 million potential value.
You want you to capture all of it.
So subscribe to Channel Vest and hit that notification bell. That way you will never miss our next deep dive into building generational wealth.
And we leave you with a final provocative thought, and it comes straight from Warren Buffett himself. Our favorite holding period is forever.
Why does that one single mindset, the power of forever, separate the average investor who's chasing quick gains from the elite who build lasting legacies? That's what we want you to be contemplating this week. We'll see you next time.